Okay, I think we probably have some folks online with us here. So thanks everyone. I appreciate you joining today and welcome to Out of the Weeds Live. My name is Nish Sampath. I'm the founder of Switch Advisory. Most business owners today don't really think about exit when they're signing their first shareholder agreement. They certainly don't when they're structuring their holdco or when they're doing their first deal with a co-founder. But 10 years later, those are the decisions that can come back to bite them on the ass. What we're talking about today are the decisions that founders make often early in the days that can cost them pretty significantly at exit. My guest today is Winta Asefaw, partner in corporate and M&A law at Castles, one of Canada's top law firms. She advises business owners through some of the most significant transactions of their lives. Winta, welcome. Thank you so much for joining us today. Would love for you to give the audience a little bit about yourself, a sense of who you are, and the kind of work you do before we kick it off.
Thank you, Nish. Thanks for having me. And thank you, everyone, for taking the time to be here today, especially on a Friday. We appreciate that. As Nish said, I help founders and businesses through all stages of the business process. So that includes the formation process, all of the corporate commercial needs. So, agreements, divestitures, USAs, different, whatever the needs are, depending on what the business is, and then also on exit. So, exit can be obviously a very fun and exciting process for a founder, but also can be fraught with a few, I don't want to say issues, but a few prickly scenarios, which are hopefully after this easy for you to avoid and understand, easy to understand. So that's what we're here to talk about today. Looking forward to it. And Nish, I'll let you continue on.
Amazing. All right, so let's kick it off. First question. Let's talk about a time that you ran into when you were doing diligence on a sale and realized that, something the founder had done in the early days was about to cost them as they're going to sell.
Yeah, so that's that's a great question. We have had a few scenarios where we find out, unfortunately, when we're representing the seller early on, but much later than we would like, that the seller has made some sort of a promise, for example, to another shareholder, an equity holder, or an employee that will be triggered by the sale. And unfortunately, because of the lag in time between when that verbal promise was made, or even if it was written, if it's not properly documented, to the time of the sale, there can be a lot of questions that come up on diligence. What are the terms and conditions for this, payment? And it becomes then a certain negotiation of where that money is going to come from on the sale. Oftentimes, if the buyer is not aware of it until that diligence process and it's not disclosed and it's a significant amount, then what happens is that's usually a haircut for the seller. And that can lead to a lot of, frustration and difficult negotiations. And this did actually happen. One of the last deals I had done involved us as actually buyer. And we found out very late that there was a significant six-figure trigger, basically a payment that was going to be triggered from the sale. There was no documentation. So what we had to do was negotiate again with the seller on what their purchase price ultimately will be, where the funds would come from, whether those funds would come from pre-closing cash flow or post-closing cash flow. And ultimately it was a last minute problem that we had to work through and smooth over, but all got settled. Not well, it got settled, but it was obviously a bit costly, and it was something that could have been very easily avoided had the founder kind of anticipated that this would be an issue on sale and properly documented everything.
Yeah, that's super interesting. And the most common version of that we see on the operational side is really that ambiguity around decision making across partners or even between co-founders, where maybe somebody has stepped out of the organization, so they were kind of really heavily involved and then they stepped out over a period of time. And even with like couple led organizations, so there's a spouse relationship leading a business and they haven't actually defined who has the authority to make what kinds of decisions, especially things around exit, right? Earlier on. And by the time that exit comes about, that ambiguity becomes almost a real cancer, right? People are fighting. And it's instead of like, moving towards a positive outcome, it becomes so stressful. So from your seat, is that something that can actually be managed at inception, like in the USA, in the shareholder agreements, or is it always going to be a fight downstream?
So I would say a significant amount of the like issues that might come up on sale involving third parties can be properly or significantly mitigated by proper agreements, such as a USA. The USA is a significantly beneficial, effective tool for managing how people enter and exit a business and also what their rights are throughout their time as an equity holder. And most importantly, who gets control or what happens. It lays the foundation and gives you really kind of a process that you can follow upon a sale, or if a founder is looking to exit from the company. And it's just such an effective tool. Everybody, I think, if you it doesn't matter if you're husband and wife, it's a good way not only to look optically very organized, and showing that you've thought about some of these things to a third party if you need additional investors down the line, but it also signals to the buyer that you have properly thought about some of these items and you are going to be in a very good and strong position to properly negotiate during that process and get all of your stakeholders in a position to sell. So it's an exceptional tool. Highly recommend anybody with more than one shareholder look into it, ask their advisors whether they need it, and they can give them a breakdown of why they're effective, what the key kind of terms we would see in them are, and why they would be beneficial, even if the business or the founders don't think they need it now, why it would be beneficial down the line. It's a form of insurance and it's a great one.
It's almost like a prenup to some
Yeah,
degree
it is.
for your
Well,
for
it
your
is.
business, right?
Yeah, it's funny you say that because there have been scenarios where even husband and wife or partners dissolve a marriage, and it's effective again to have that USA in place because for your other shareholders, if they, for example, have, party A is married, if party A gets divorced, well, the shares are considered assets that are, divisible under like throughout that divorce process. So they
Mhm.
want to ensure that they're in business with who they actually signed up to be in business with, which is partner A, but not partner A and its spouse, or, whatever the case may be, maybe even just the spouse. So it's a very effective tool. We've seen it come in handy, especially in that type of kind of disintegration of relationships, which also includes marriages. So very effective tool. Cannot speak highly enough about USAs. Definitely make sure you know about them, and you utilize them.
What are some of the key elements that you would recommend people focus on when they're putting their USA together? What are some of the kind of top clauses that make sense?
Yeah, so if you are a founder and you receive a third party, like a genuine offer from a third party to purchase your shares, you want to be able to drag your other shareholders along with the sale, right? Basically, ensure that they participate on the same terms and conditions that you've signed up for. Because as a buyer, you're going to say, well, I want to own, like 9 times out of 10, buyers will say, well, we want to own the company in its entirety, or at least be able to select who we leave equity with on the table. So if you own less than 100% of the shares, you want to ensure that when you exit, you're able to have the other shareholders participate so that the buyer is actually, satisfied with the number of shares or the percentage of shares that they'll own.
That makes a ton of sense, actually. Okay. And I'm assuming that includes decision rights within, who gets to determine how much we sell for, who we're going to sell for, the structure of the deal, et cetera? Or is that incorporated in other documents?
No, that's exactly correct. The USA would contain that at a high level, essentially say that if the third party offeror provides terms X, Y, and Z, those are the material terms, all of the shareholders then have the right. Sometimes it's a right to participate, other times it's the founder has the right to drag them along and ensure that they participate in that sale. But the terms and conditions you get to govern, like in the case that I'm using with the drag along, you get
Mm-hmm.
to essentially ensure that you are the person negotiating those terms. that at a high level, the idea is if they're good enough for you as the founder or the majority shareholder, then in theory they should be good enough for the others, and that's how minority shareholders protect themselves as well, because the offer has to be on the same terms and conditions and a genuine offer from a third party, rather than my holding company is going to offer 1 cent on on the dollar for each share, just to provide some protection. So it's a good effective tool. Oftentimes it's pretty fair, but it also allows you to ensure that the intention of where control is supposed to be is actually is maintained there for the majority shareholder, often the founder or founders. And that's really important, because by default, under the law, under statute, but also common law, there's certain rights that minority shareholders have, or that all shareholders have. So the USA works well because it considers those, but also considers the actual relationship dynamics, the risks, the nature of the business, and it ensures that it's a good, I always say it's kind of like the Bible for how things are going to proceed in the business. But it's a very effective tool when things get tough. Egos can be high, frustrations can be high, and it can also be a very effective tool to protect you if you're maybe not the most liquid partner, but you are the person who started the business and have the most I don't want to say leverage because you're the founder, but you are maybe like the crux of like the brains behind it, right? It's a
Yeah.
good way for you to kind of leverage, maybe if you don't have the cash to do certain transactions, buy out your partners at certain times. It allows you to still maintain control. So it's contextually
Totally.
applied, but very good, very effective.
And I think just having the rules of the road set out before any major decisions happen, allows you to preserve relationships, frankly, right? You don't want to be going out of this and, breaking key friendships or relationships with partners, etc.
Yes.
So, kind of continuing down that stream, what are some of the other things that early days we should be considering when we're setting up a business around, things around company structure, intellectual property? What have you seen that have really, unfortunately, lit a fire at the exit?
Yeah, so that's a great question. And those are two key points you've touched on. So, for example, IP. If the nature of your business relies heavily on IP, you have something very proprietary, but you have had poor documentation along the way in terms of who actually owns the IP. Does the corporation actually own the IP? If there were founders that have exited, have they ensured that they contributed their IP? Have they made assignments? Have they waived moral rights? Essentially, does the corporation at the time of sale own what it says it owns, right? And if you aren't able to prove that you actually own what you say you own and you're selling, or what the corporation owns, depending on what the structure, of course, of the transaction is, what happens is the the sellers are ultimately going to be burdened with additional reps and warranties, which are essentially like promises. It's fancy legalese for promises that the seller
Okay.
will make to the buyer. But those promises are very important, because if they are later found not to be true and there's a cost to the buyer or the business, then essentially that's money out of the seller's pocket. But if that rep and warranty doesn't exist and there's something that happens post closing, of course, the seller's liability is reduced significantly. Or in this case, if it's not there, it's removed, obviously subject to nuance and other rules. But with that being said, the cleaner your documentation, the more you can prove you own what you own, including IP, which obviously in today's market is very relevant.
Hmm.
And that hasn't been done from the get-go, then unfortunately what that means oftentimes is a longer indemnity period, stronger reps and warranties in favor of the buyer, or a discount to the purchase price. Or sometimes what we do is we'll do a holdback. And a holdback, obviously money today is better than money tomorrow.
Absolutely.
And yeah, so it just creates a lot of deal complexities that maybe didn't need to be there, but it also adds to the weight, the breadth, and the length of what the seller is going to be on the hook for after the deal closes.
So tell me about how do we create that protection? Is that employment agreements, subcontractor agreements? Where do we usually put that kind of protection in
Yeah.
place before we run into trouble?
Yeah, so those two are exactly correct. employment agreements, key. Contractor agreements, correct.
Hmm.
Really, it's any party that's engaging with the business, any third party, um, including like the employees, contractors. What you want to do is you just want to ensure in there it's very clear on who owns what after the terms of engagement. So that is exactly correct. You hit it nail on the head.
Amazing. Anything else that you think the team should know here, the folks listening, around early stage decisions, corporate structure that they should be considering?
Yeah, so you touched on tax too, and I think that that's
Hmm.
extremely important point to bring up because the seller obviously is going to get a ton of money at the end of the deal, but they want to be sophisticated in how they receive the purchase price, but also structure the deal in order to ensure that they are having a it's tax friendly for them.
Absolutely.
So, with that in mind, though, obviously the corporate structure from the onset is critical. If the corporate structure is done well with the anticipation, it doesn't necessarily have to be right on onset. Right on onset is very important for other like liability mitigation, but from a strict tax perspective, there are often, restructurings that can happen from the time of inception to the time of sale. However, a seller will ensure that they do that slightly before the buyer is engaged. And I say that because if the buyer is involved, which we have been on the buyer side and we've had this also on the seller side, what can happen is the buyer will then have an opportunity to review. It's considered a pre-closing transaction. So the buyer will have an opportunity to say, well, hey, you want to do this? Actually, that might have an adverse effect on me or the corporation. So that's not going to work. And we did have a deal where it was a cross-border deal. We were ready to close, and then last minute there was an issue where the buyer said, you know what, this is actually not going to work for us as proposed. And that just translates to additional time, costs, and negotiations that probably would be better suited to have happened much earlier. So getting your corporate advice, or sorry, your tax advice to ensure your corporate structure is done well is important, well before you engage the buyer. If you want to have the opportunity to market it and kind of, um, present it to the buyer as you wish, as you want it. But the
Makes
second
sense.
the buyer is engaged, that it's open for negotiation, right? And that goes into their purchase price.
So what's the optimal window? Is that 18 months? Is that 36 months before you're even consider, like you're kind of thinking about it, you're probably heading down this path and you're saying to yourself, listen, we're looking for an exit event in the next couple of years. I unfortunately we work with lots of folks they want to sell tomorrow. And, there's some reality around what we can switch up and how much of the organization can be changed in that window. When should they be thinking about these changes?
I think, as you noted, like early on, talking to a tax advisor early on is always important. Engaging a tax advisor before you start, like if you're soliciting kind of bids, then obviously before that process starts, I would say 6 months probably sounds like a happy medium because that gives you enough time to complete the transaction, but also enough time to ensure you have adequate opportunity to consider the different options your tax advisor may present you with. And at that time, it's close enough to the sale that you also know who is going to participate in it actively. It might be a scenario, for example, where you've talked to one of the shareholders and you know that, I don't know, they're retiring in 3 months. So they might actually, by way of the USA, automatically have their shares purchased by the company or the other shareholders, and they won't actually be a party to the transaction. So you'll have a clearer picture of who the shareholders would be, what the company's operations would be, what the corporate structure would be closer to that time. So I'd say maybe 6 months would be a good happy medium.
Awesome. Awesome. All right, let's switch gears a little bit. Tell me about a deal where it was obvious that the founder was the business, right? Where the founder dependency is so significant that, these red flags start popping up because the buyer sees the implications and it's going to impact deal structure, right? There's one person who is the majority of the business.
If during the diligence phase or any part of the transaction, if there's a document or item of clarification that we're requesting and nobody on the team can produce it because the seller is on vacation and unavailable, which happens more often than I'd like to see, then obviously there's an issue and it might just be like, I don't want to say poor, but maybe like, the founder hasn't adequately shared where those, how those processes work, where that information is. But for us, that's a red flag, because that means that if we're having the seller engaged as an advisor to the business for transitional services post closing, and there's a risk that they, for some reason, don't complete the term as we wish, then we might be in a position where no one knows how to operate the business post closing. And because, that kind of operational knowledge is not available for us to kind of absorb before the seller is unavailable. And we have had that. And that is a very unfortunate situation, because post closing, the purchaser is trying to get to know its employees, trying to, make sure the third party contractors have a good relationship there. There's a lot of relationships they're looking to maintain. But what they're really also looking to do is ensure that the seller is helping with that transition, helping them find out where they need to make this payment to, or who they go to if this, I don't know, a light bulb goes out and there's an electrical issue. These are the
Mhm.
small things that, if the founder has kept all of that knowledge in their own head and nobody else is available to assist, can be quite frustrating. It might seem very trivial, and insignificant, but it can have a material impact on such a key time frame post closing.
Yeah, you know what? From our perspective, the prospective buyers, we've seen them become pretty significantly gun shy around businesses they're built on the backs of that single person, right? The founder dependency is so high. And it turns out it's a significant red flag, because the buyer's not sure that that business is scalable, right?
Yeah.
If it's one person driving this, can the rest of the folks that are left behind or coming with the deal, can they help scale the business? And when the buyer sees that, we've seen people walk away quite often, because they don't believe that this machine can be appropriately scaled without rewriting the entire operating system of the business. And they also, we've had a lot of concern where the financials and the P&L, they might tell a story, but the buyer doesn't think that it represents the actual resource cost required to manage the business, because founders doing 14 different jobs, they've kind of been, running off their feet, doing it all themselves just to keep, higher margins. But the reality is, to scale this business, it's going to take more people. And even if we inject more money into it, there's no operating system that allows it to scale.
Yeah, I think that's a great point. Oftentimes we'll ask the buyer, do you have a sense of how many hats, operationally the founder is wearing? Because once they leave, you might need to rehire for 3 full-time positions, right? And what does that look like? And on
Mm.
top of that, it's funny, as you were talking about this, I thought another big key piece I think that founders sometimes miss, especially, when they're starting off a bit smaller, do not use the company's credit card and finances bank account as your personal account. That
Mm.
is important. Like, there needs to be a delineation between corporate expenses and personal expenses, and not blurring those lines early on, and having very healthy practices on how you document your finances, document certain, procedures, mechanics. But finances are so important. It just signals to the buyer very early on that you're organized, you understand that there is a separation, and it's a piece that has become a problem in the past. So just
Yeah.
important to keep that in mind.
So you're saying the yacht is not a legitimate capital expense?
I mean, you
Yeah.
could take a client on it, I'm sure, once once in a while. It's probably a question for the tax advisors, but
Yeah.
yeah,
So
good
when a
to know.
deal, yeah, so when a founder dependent deal does close, what does that structure usually look like? Are these deals, where the founder ends up trapped in that 3 year, 5 year earnout, where they're working for the buyer for a long period of time? Because I'm guessing in most cases that's um, pretty opposite to what they were envisioning when they were looking to sell.
Yeah, that's right. And they've just gotten this huge chunk of money, and a beach is calling them. The last thing they want to do is go back to a place where they were running the show to now being, an employee or a contractor. It's a very difficult shift, right? I'm
Hmm.
sympathetic to that transition. However, you're right. It shows up in two ways. Oftentimes, we have them locked in for a transitional period. Usually, we'll try to have a holdback so that we can ensure they actually stick around and properly complete the tasks they are agreeing to do during that negotiation phase so that their post-closing transition is smooth for everyone. The other
Yeah.
way it shows up, as you said, is earnouts. You're confident as a founder, as a seller, that the business, the cogs are going to be turning and the machine is greased. But if the buyer is not confident, they'll say, okay, so then essentially it's put your money where your mouth is, right? We'll ensure we'll maybe agree to this purchase price. However, we're going to have a long earnout period because we want to ensure that everything you're telling us to be true. For example, that these relationships even are not contingent on just me as founder. Like I've integrated my team, into those
Hmm.
relationships. That post closing,
Absolutely.
we're still going to have those and we're still going to make money and our employees are still going to stick around. Employees are obviously the crux of every business. If you don't have good people running the business, then unfortunately it's going to be a very tough business to be profitable, right? So those are the kinds of things that will then lock the seller in for a long time. And then it's again that concept of the time value of money. Money today is better than money tomorrow. Having these kind of, handcuffs or restrictions on what you do post closing is, I imagine, I haven't been a seller of a big business, but I
Yeah.
imagine it would be very difficult because you want to go enjoy this next phase, but you're kind of in a transitional period yourself. So that's how it shows up.
Yeah. I mean, when I speak to owners, I think oftentimes when they hear earnout, they think, okay, this is how I'm going to take part in the upside. But often, do those earnouts actually pay out the way they were sold to the seller, or do you see it kind of turning out not as profitably as they were hoping?
Um, I've seen a mix.
Okay.
And sometimes it could be that the purchase price that the seller thinks in their head um, is actually not realistic. It's, in a nice way to say it, it's maybe inflated based on what they perceive to be the value of the business.
Right.
And so as a result, the earnout thresholds are calibrated. They're proportionate to what the purchase price or what these promises and the founder's kind of idea of what that profitability will be post closing. So
Hmm.
sometimes earnouts aren't met, and as a result, it is effectively just a haircut on the purchase price, but they're probably a true reflection, a better reflection of what market would be for that business based on how it was operating at the time of sale. So it's tricky though because once an earnout is involved, the buyer and seller are going to be in a position where they might have different ideas post closing on what's acceptable. From, for example, like if it's an EBITDA based threshold, then spending obviously matters, and the buyer might say, well, there's a great opportunity for us to refresh our assets here. It's going to be a big spend, but it's worth it, right? Or capital assets, or whatever the case may be. Or we
Hmm.
want to hire and grow our team, scale the business, bring in AI, whatever the case may be. And the seller will say, well, hey, listen, that's actually going to impact my ability to meet this earnout threshold. So as a result, the negotiation during that period of the share purchase agreement or the asset purchase agreement, whatever the definitive agreement is, becomes very not contentious, but it's there's obviously differing views and positions on what those restrictions should look like.
Yeah.
And it's just, ultimately, if you can be in a position to not have to go through a process where you have an extremely long earnout period, that's caused simply by the fact that the buyer is apprehensive about what post closing will look like because they think you are too critical to the business that it might not function as well after, then that's
Hmm.
not great. If you have an earnout because you have a potential to, share in the profitability and it's almost like a profit share, then that's great. You're going to probably get more than market for your transaction. So it kind of depends, but you definitely don't want it to be triggered by fear.
Yeah, and I think that's exactly where building that repeatable operating system within the organization is so critical. If you can build that confidence that this thing can run without you, and if you put a little more fuel on the fire, it can continue to grow. Well, if the seller has that fuel, all the power to them. But once you sell, you lose the power to control that conversation, right? And the seller now has that power, and they can impose additional expenses that are going to draw you down, and that's unfortunate, but that's sometimes where they live. All right, coming to just a close pretty soon. Let's talk quickly about negotiation dynamics, right? On the negotiation itself, where do you see founders most consistently leaving money on the table just because, frankly, they don't actually realize that that's part of the deal that they could negotiate? reps and warranties, indemnity, etc.
I think not getting their advisors engaged early and then having to kind of discuss some of these issues that we've raised with the buyer during their
Mm-hmm.
negotiation with the buyer creates a position where the buyer is going to be able to say, well, hey, this is a risk. We're flagging it. And as a result, oftentimes it's an impact to the purchase price or the liability of the seller. So getting your advisors in early, cleaning up house early, making sure that when you come to the table to negotiate, that you already have your answers to these questions that we've raised. Everything's kind of neat and tidy, or you at least have a plan and an idea of how to address them. I think will give the buyer confidence, and then the seller is not left choosing between a few options the buyer is presenting, and trying to meet them in the middle. They've come prepared and organized, and then they can kind of lead the negotiation, and that's important.
Having the right team sounds like a pretty critical element to that, right? Just the right advisors from the financial side, the operations side, the legal side, making sure the machine's running well. This has been awesome, Winta. Thank you so much for your conversation today. It's exactly what owners really need to be thinking about earlier on in their journey. For anyone watching who wants to connect with Winta or learn more about Castles and their M&A practice, you can find her on LinkedIn. I'll drop her profile in the comments afterwards. But genuinely appreciate everyone joining us today. Thank you so much, and we'll see you
Thank you.
soon.